In Chapter 8, we're going to be recording closing entries. We're going to journalize and post closing entries for a service business organized as a proprietorship. There's a need for permanent and temporary accounts. Accounts used to accumulate information from one fiscal period to the next are called permanent accounts. Permanent accounts are also referred to as real accounts. Accounts used to accumulate information until it is transferred to the owner's capital account are called temporary accounts. Temporary accounts are also referred to as nominal accounts. The need for closing temporary accounts. Journal entries used to prepare temporary accounts for a new fiscal period are called closing entries. The temporary account balances must be reduced to zero at the end of each fiscal period. The need for the income summary account. When revenue is greater than total expenses, resulting in a net income, the income summary account has a credit balance as shown in the T account. When total expenses are greater than revenue, resulting in a net loss, the income summary account has a debit balance as shown in the T account. Closing entry for an income statement account with a credit balance. The account that has a credit balance is sales. The closing entry would be dated the 31st. Sales is the debit, income summary is the credit. Because in order to close out sales as a credit, you have to make it a debit. We want to zero out this account. The heading closing entries is written right underneath the adjusting entries. And then you put the date, sales as a debit, income summary as a credit. Closing entry for income statement accounts with debit balances. In the income statement columns, all of the expenses have debit balances. In order to zero out those accounts, we need to make them credit balances. So you would put the date. Income summary is the temporary account we're going to use to close out these accounts. So income summary is the debit. Then you would list all of the expense accounts and their amounts. You would add up the expense accounts, and the total is what the debit amount is for this closing entry. The closing entry to record net income or loss and close the income summary account. So this closing entry does both. So if you have net income, the income summary is going to be the debit and the capital account will be the credit. You put the date, income summary, debit, capital, credit. Now if you had a net loss, these accounts would be flipped. The capital account would be the debit and the income summary would be the credit. The last closing entry is for the owner's drawing account. So if you look at the drawing amount on the balance sheet section of the worksheet, you'll see that it's a debit balance. So in order to close that out, that account has to be the credit. So the capital account is our debit and the drawing account is our credit. We put the date, put the capital account, and then the drawing account. What do the ending balances of permanent accounts for one fiscal period represent at the beginning of the next fiscal period? Beginning balances. What do the balances of temporary accounts show? Changes in the owner's capital account for a single fiscal period. List the 4 closing entries. An entry to close income statement accounts with credit balances, which would be sales. An entry to close income statement accounts with debit balances, which would be all the expense accounts. An entry to record net income or net loss and close the income summary account. And an entry to close the owner's drawing account.